And welcome back to Market Watch. Our topic today, managing your 401k, specifically diversification. You may be pleased with the performance of your company stock, but what's the risk of putting all of your eggs in one basket when it comes to your 401k? We're going to take your questions at 1-800-752-CNBC. That's 1-800-752-2622. And here with some answers and advice on diversifying your plan, Scott Lummer, investment advisor with 401k Forum. He joins us from St. Louis. Nice to have you with us.
Nice to be here. Thank you.
At this point, given these turbulent times in the market, what's your understanding of what investors actually are and have been doing with their 401k money during this period?
Well, roughly about 30% of all 401k money is invested in company stock. And of course, it's the larger company plans that have the lion's share of that. 80% of large companies offer their own company stock as an option in their 401k plans.
Now, what should investors be doing when the times get turbulent? How much, for example, how much asset reallocation on one's own should one be doing?
Well, in general, people shouldn't be reallocating just because times are turbulent. They should be allocating in their 401k plan based on their long-term expectations, not just on what things will be doing over the next week or next month. That being said, I think this has been a wake-up call for a lot of investors who realized even for the long term, they were not as well diversified as perhaps they should have been.
Let's talk about diversification and specifically how much money you put in your own company stock. That tends to be a problem, doesn't it?
It does. Certainly during good times, and particularly companies that were doing very well during those good times, lots of investors benefited tremendously from having large allocations to their 401k or to their own company stock in their 401k plan. But during turbulent times, the reverse can happen. The markets are going down. Some stocks are doing a little better than the overall market, but of course some stocks are doing particularly poorly. And to have a large amount of your long-term retirement money tied up in your 401k plan, tied up in your own company stock, can be very, very risky.
Somebody wants to explain to me the concept of market risk versus security risk, and certainly we have market risk here, but then the security risk being that one company in which you are totally invested can have its own problems irrespective of the market. Is that an issue here and one that people ought to keep in mind?
Sure. I guess there are really two specific types of company risk. First of all, your own company could be doing much poorer than the overall market. Let's say right now your company's out on strike. Well, that would mean that its stock performance is probably doing poorer than the overall market, and the overall market's doing poorly. Secondly, some stocks are just riskier than the overall market, and so, for example, high technology stocks have been really decimated over the past couple of months, and unfortunately, it is particularly that sector of the economy, high tech companies, that we often see a lot of the employees investing a large proportion in their own company stock.
Let's take a call, shall we? Jim in Michigan's on the line waiting to talk to you, Scott. Go ahead, Jim.
Hi. I just got into my company's 401k for about 2 years now. I have 40% going to Janus Worldwide, 20% to Brandywine, 20% to Putnam Asset Allocation Balance, and 20% to Fidelity Equity Income 2. I was just wondering if you could tell me, is this a good choice or should I change it around? Thank you.
Well, thanks for your question, Jim. In general, it sounds like you have a good concept of diversification. You're spread across 4 or 5 funds, and that certainly makes sense.
Yeah, but doesn't he also need to take a look at what these funds do? He can be in 8 different funds, but if their objectives are all the same, he's probably invested in the same stocks?
Sure, but he does have some diversification. He mentioned that he has money in a global fund, Janus Worldwide, and certainly that's a smart play to have some of your money in an international fund. The domestic funds will likely all move together. Of course, Brandywine is somewhat of a problem child earlier this year in that they really lost out by having a heavy investment in cash, and so that's a fund that might be a little riskier than the average fund just because they tend to do a little bit of timing.
Right. Paul in New Jersey, you're on the air. Go ahead.
Hi, how you doing today? Thanks for taking my call.
Sure.
I'm getting ready to retire next year. I'm 61 years old this year. I'll be 62 next year, retiring in April. I'd like to know what you think about the way I have my money allocated right now. I'm 35% in fixed income, 20% in the balance fund, 10% in my company, Air Products, and the balance is in aggressive growth. My question is, should I move my aggressive growth right now, get out of it, put it into fixed income where it would be safer for retirement?
Well, I think the issue is not, it depends on what your motivation is. Certainly, if you're very anxious about the current market conditions and you think you're going to continue to be nervous about that and you're having trouble just sleeping at night with that portfolio, you might want to scale back some of that equity and put a little bit more in fixed income. I certainly wouldn't suggest taking all of it out, but if the past couple months have made you very edgy, you might want to scale back. Not necessarily just because stocks have gone down, but just because you want maybe a little comfort level. You're going to be needing that money in a couple years.
In 15 seconds, what's Lummer's law?
Lummer's law of diversification?
Yeah.
Lummer's law of diversification would say certainly as you're nearing retirement, you should have more and more of your money in fixed income, and in your equity funds you should be diversified at least into 3 or 4 different equity funds.
That was it. A pleasure, and thanks for the 15-second bite. Appreciate it. Scott Lummer, 401k Forum, live from St. Louis. Coming up in the next half hour, we'll bring you the latest on today's big market sell-off, plus which emerging growth sleeper stocks are right for your portfolio. We'll ask fund manager Jim Kalinin of Robertson Stevens. This is Market Watch on CNBC. The Dow's down 204, the S&P's off 24, the Nasdaq is down 41.